Welcome to another episode of the Know Better, Do Better series. And I am here, literally here with my girl Chloe today. So if you are watching on YouTube, you have us both in person. If you're listening, you don't know the difference. We're going to be passing the microphone left and right, or microphone left and right, because we're not great at technology, but you're going to be able to hear us better because we're using our microphone. So let's get this party started.
All right. So we'll start out with Trends, Taxes, and Tea, where we share the latest trends, how to save money and pay less, or just give you some good old-fashioned tea about what's happening with pop culture and money. So today we have a trend. The COVID-19 pandemic was a big wake-up call, and it caused a lot of us to revisit or visit life insurance and estate planning. And so that's our topic today is life insurance. But according to a recent Deloitte survey, life insurance applications saw the biggest increase in the last decade, and the growth was widely driven by people that were under the age of 44.
So what I'm hearing is the young folks, the millennials is what they call us, are the ones that are purchasing insurance. And in light of all the things that have happened, we are grown-ups, but maybe haven't thought about that a whole lot. And mortality has become a really big issue over the last year or so. And so we now have that as a thing that is top of mind for us.
Yeah, definitely. And so today we're going to talk about life insurance and just kind of, before you go out and get a policy, we want to make sure that you understand kind of how these policies work, what's the best option for you, and just some basics to help you get started.
So one thing that I do want to say before we actually do get started is that neither Chloe nor I sell insurance. So that is one of the popular misnomers about financial planners, is that we are all trying to sell a financial product to someone. In fact, we are certified financial planners that are fee only and fiduciary, just slightly different than the person who may refer to themselves as a financial advisor, but may or may not be a CFP, and their main means of income is selling insurance. So this advice that you're getting from us is holistic and unbiased. So let's get the party started.
All right. So first of all, we'll start out with just to kind of level set a bit the purpose of life insurance. There's a lot of different things that you might hear out there, and people think of it as an investment or just this great thing that you can take advantage of. But the real purpose of life insurance is to provide financial support for your spouse, your children, or anyone who depends on you, and would be affected if you were to pass away. There's a popular saying that you don't buy life insurance because you're going to die, but because those you love are going to live. So just think about that as you're thinking about, do you actually need life insurance? Is it something that is appropriate for you? Do you have people who you support financially or would be affected if you were to pass away?
And what stands out to me here is this idea that, because those that you love are going to live. And it may be that you could care less about those that you're leaving behind. That is something that I've encountered, is people say, you're just going to have to figure it out on your own. But I know that the conversations I've been having with my clients and in my community are about generational wealth, and particularly about closing the racial wealth divide and using generational wealth to start to be able to do that. And life insurance is one of those things that is going to make sure that people are taken care of in your absence. So to really be thinking about this from a different standpoint. And the other thing I like to say too is like car insurance, health insurance, all these other kinds of insurance, homeowners insurance. They are insurance where you purchase them and you don't get anything out of them should you, if you don't need it. When we think of life insurance, I know Chloe's going to get to talking about this in just a second, but this idea is that you're insuring something. So we're hoping that a catastrophe does not happen, but we are insured in the case that a catastrophe does for some reason happen. So be thinking about that.
Yeah. And something that we've said multiple times on this podcast is, GoFundMe is not a life insurance policy. And so you definitely want to make sure that, this is something that's super important for you to get. If you do have people that depend on you, so that, people aren't scrambling to get money together to pay for your funeral and scrambling to kind of, pick up the pieces and support themselves afterwards, if something were to happen. So let's talk about how much life insurance you actually need. there's so many different ways to calculate it, but the first thing I'll say is that, a lot of people underestimate how much insurance they really need. I talk to clients all the time and I'll tell them, you need $1 million or you need $1.5 million or 2 million. And they're just like, whoa, like that's a lot. and they wonder why they need so much insurance. And they kind of question or push back on it. But, you really have to consider all the different pieces. So some of the fundamental pieces is your financial obligations. So any income that you're bringing to the table, if you're the breadwinner in the household, that income needs to be replaced if something were to happen to you. Do you have debts? If you have a mortgage, let's say your mortgage might be $300,000 or $400,000. That alone is, $300,000 to $400,000 that, would you want to have this, your surviving spouse or your children, having to be responsible for paying that mortgage? Do you want them to keep the house, in the family? And then any other needs, like if you have children, there's college expenses that you might want to make sure they're taken care of. There's funeral costs. So just, once you add up all those things, that could easily be at least $1 million.
Yeah, you bring up some really good points. And I think this is the thing where pretty much every client I have that's come to me has been underinsured. They're like, but I have, this much insurance, and that's a lot of money, because when you see the insurance policy, maybe $500,000 as an example, that's a lot of money in most people's kind of frame of reference. But when you think about if you have a 5-year-old and you need to take care of that child until they're 18 at least, that's 13 years of your income that would have needed to be in action in order to help that child. When we think about, like you said, mortgages and things like that, what happens if, it's a 30-year mortgage and you pass away 5 years or 10 years into it? It's 20 years of someone needing to take care of that on their own without your income coming into consideration. So if you have children under that roof and you want your family to be able to stay put, those are the things you need to be thinking about. It'd be nice to be able to just write a check for the mortgage and then, be able to figure out the other aspects of your finances in your absence. And then, Chloe brought up to college expenses. So as we talk about generational wealth and the things that we want to create for the future, maybe your children not having to take out student loans is one of the cool things that can happen because you have proper life insurance. So need a lot more than what you're just probably seeing right on the front end. And it's going to sound like a really big number, but your family's going to thank you for it later.
Yeah. And so, once you think about all of those obligations, just think about how much you have existing in savings or investments that could be used to support your family or to pay off that debt. And really the difference between what you have and what you need is the amount of insurance that you'll need to cover everything. So we're actually going to put a couple of articles in the show notes that explains different methods that you can use to calculate. And there's also a quick and easy calculator because the calculations can get complicated. But something important to think about here is that you want to make sure that you figure this out for yourself. Think about what you want to be covered and what's important to you instead of having an insurance agent tell you how much you need. And we talked about home ownership before. And, you want to make sure that you, for any of these things, before you go to someone who may not have your best interest in mind, you want to make sure you understand what you need and not rely on someone to tell you what you need, especially if they're selling you the product. So the next thing that we want to talk about is just, what type of life insurance do you need? There's so many different types of life insurance. You've probably heard of term, and then there's really only two major types, term and permanent. But within that permanent, you probably hear whole life, universal life, index life, anything that has cash value is permanent. So the two major types are term insurance and permanent. And so for most young professionals, we would say, term insurance makes sense. So basically term covers you for a period of time or a term. And in some cases it could be, 10 years, 20 years, 30 years. But basically that once that term is over, then that policy expires and then you stop paying premiums. So we think this is ideal for young people just because, it's definitely cheaper, it's simpler, and it gives you the opportunity to get a lot of insurance for a pretty low cost while you're still building up your assets. So ideally, by the time 20 years from now or 30 years from now, hopefully you've saved up that money that could replace the need for insurance.
So let me just say that in Lauren terms, not layman's terms, but Lauren's terms. So imagine you have a term life policy for the same $500,000 and it's going to cost you $50 a month. A whole life policy or a permanent policy that is of the similar amount, maybe like $500 a month. And I didn't do any calculations. So the point is that one costs more than the other. So in that case, it's like, okay, I could pay $50 a month for the next 20 or 30 years, and I could be investing the other $450. I'm going to have a significant amount of money later on down the road. And in 30 years, I shouldn't, or 20 years, I shouldn't need the term insurance anymore. And so that's the thing to be thinking about. And I know, like I said, once again, people are just like, but it's throwing money down the drain. That is the narrative all the time as it pertains to term. But I would circle back to what I said earlier with car insurance. They don't give you any money back. Homeowners insurance, medical insurance. These are things that are going to insure in case of a catastrophic event. You should think of your life insurance in the same way.
Yeah, definitely. And something else to think about too. I mean, I know some insurance agents will say, most people don't save up enough money. They go the 10, 20, 30 years and they're not investing that difference. And so they're 50 years old now, and then they don't have any more insurance. And then it might be expensive to get another policy. But hopefully if you're listening to this podcast, you've learned from us that you need to start saving early. And start investing early. And so you should, theoretically be in a position to replace the need for that life insurance by the time the term is up. So just to explain whole life, quickly, basically whole life builds cash value. So there's, so that in addition to just the cost of the insurance, which is what, you pay for with term, the additional premiums that you're paying, which are a lot higher, that goes into building up a cash value inside the policy. And some insurance agents might tell you can borrow against that, or you can use that for income at a future date. But that's just something to be a little bit, kind of cautious of. We don't want to getting into the details is probably too much for this podcast. But just, understand that whole life is only appropriate in certain situations. And it's not the best option for everyone. And so just, make sure that you do some research and kind of understand what makes sense there. And then also, like Lauren said, understanding what you can afford. And you might, be in a position where based on the need, term works best. So
hold on one second. So once again, in Lauren's terms, so one of the things that I've bumped into quite a bit is in communities of color, people being really happy that they had their whole life insurance because they were able to borrow against it when poop hit the fan. So the idea is that we're leveling up here, that, like you said, by participating in this podcast, listening, learning all the different things that we're sharing with you, investing additional time on your own, that you'll realize that, things like an emergency fund are important. So you wouldn't need to borrow against your life insurance in a situation like that. And that they're kind of glorified savings accounts when you actually look at the returns of these life insurance policies. And so you really don't want, to be putting this money over here when you could be putting the money somewhere else. And we just have to discipline ourselves, and we first need to know better so that we can do better. So just be mindful of the idea that, this is, it was the best thing that ever happened to me because my car broke down and I had to borrow against my life. Like, that's not our goal here. That's not what we want to be using our life insurance for. We want to be insuring our life.
Yeah. And something else that I'll mention there too is, when you do take out that loan, it is a loan and there is an interest rate associated with it. And if you don't pay it back, that just eats up against the future cash value. So those policies can blow up and they can, not exist anymore if you're not putting in enough in premiums to keep the policy going, or if you're not paying back those loans. So there's a lot of complications that can arise once you start pulling that cash value out. And that's typically not explained to you about, how those things actually work. So again, like I said, do a little bit of research, make sure you understand exactly what you're getting into. But it's not, it's not what people make it out to be. And it's not something that, you probably use as future retirement income without a lot of caveat. So one of the things we want to talk about too, there's a lot of you that are single, or people that have no kids. And so generally speaking, like we said before, if you don't have anyone that depends on you for income or that would be financially impacted if you were to pass away, there's really not a need for life insurance. But there are some cases where I think it still makes sense to get life insurance when you're single. The first one, the biggest one is that if you anticipate a future need for life insurance, if you think in the future you will get married, you do want to have kids, you will have people who depend on you financially, then it doesn't hurt to get that insurance while you're young and healthy. As you get older, just things get more complicated. You could have situations where you might not be able to get insurance, or it might cost a little bit more. I have a friend who had breast cancer, and so she's not able to get insurance anymore. So luckily she was able to get it before she was diagnosed with breast cancer. But now after the fact, she's married and has several kids. So those are just things you never know what's going to happen. And so if you are young and healthy, go ahead and get a 20 or 30-year term policy just to make sure that you're covered in advance. There's other reasons, like if you're a single parent, that could be a reason why you need it. If you have, private student loans or other debts that would need to be paid off. If you co-signed on debts, you might be a business owner. You might have business partners that would be affected. But there's a lot of other reasons why you might need insurance if you're single with no dependents. And so we'll also share an article in the show notes that talks about that.
We've got all the resources for you to be able to follow up and deep dive into these subjects. The only other thing I'll say about the being single aspect of it is thinking about other people. As we talk about generational wealth, so you may have nieces or nephews, and you come from a community where that the parents of your nieces and nephews, or your sibling, if you will, is not in a good financial situation. Wouldn't it be nice, if we're talking generational wealth, for someone to inherit? And I will say that in light of COVID, I've had tons of clients come to me. Well, not tons. Tons is an overstatement, but many clients come that have inherited from an uncle, from a cousin, from an aunt, not just their mom or their dad. So when we think of it, it's not just that, you are insuring against your kids, but you can be that awesome person to be able to provide for a godchild or something like that by deciding to get the insurance. So you have to decide if the, X number of dollars a month is worth the opportunity to be able to pass down that wealth to someone else.
Yeah. And that's a great point. And we talked in a previous episode about, that first generation wealth builders tax, where sometimes if you are the person in your family to make it, you do have family members or, people that are depending on you. And so is that something that, if you were to pass away, they would be affected? And so, that's a great thing to be able to offer, like let's say your sibling is not doing great financially, and to be able to offer, some money to your sibling and to their kids to put them in a better position. Another thing that we want to talk about was just group life insurance. And so, a lot of companies might offer you some level of life insurance. It's going to be term policy, but it's just a base level that your company provides as a benefit. Most of the time, the company will pay for that insurance. And it could be, 1 times your salary or 2 times your salary or some flat dollar amount, like $50,000 or $100,000 per employee. But this is a great thing to enroll in and take advantage of. And if you need more coverage, there's typically 2 options. The first one is that you can go through your company and you can buy additional insurance and kind of get supplemental coverage. And then the other option is to go outside of your company and get just a term life policy through an insurance agent. And so what we'd say is that if you need more coverage than what your base benefit from your company provides, we typically suggest looking outside for an individual policy. And the reason why we say that is because anytime you lose your job, if you change jobs, then that coverage goes away. You don't know, what your new company is going to have as far as the benefit. And so just having that insurance tied to your company can be a little risky if you were to lose your job. So So that's just something to think about.
And we know in light of COVID that lots of people were left without jobs and thought that they were in a pretty good, stable situation. So not only were they left without income, but they were left without health insurance in some situations. They were left without life insurance. And like you said, there was a virus running around and was actually taking people's lives. So what a scary situation to be in, to, maybe your family not overnight, not be properly taken care of just because you were depending solely on your work.
Yeah, and then also with individual policies outside of work, there's so many different options that are available to you. Group policies are going to be pretty straightforward and basic, but there are some other options and just different things that you can consider with the outside policy, and you can kind of customize it to what you need. One exception is that if you're unable to qualify for life insurance because of health issues, then your group policy is a great option if you need additional coverage. So like in the case of my friend that had breast cancer. So most group policies, they provide some level of coverage without you having to prove that you're in good health. So if you have a health condition, you can get the base level of policy that's maybe 1 to 2 times your salary, and then maybe you get an additional $100,000, or you can get an additional 1 to 2 times your income without having to go through the health process. So if that's the case, and that you can't qualify for insurance, or it's going to be super expensive because of your health history, get as much as you can through your company, because that's probably your only option of getting some good coverage. So then the next thing that we want to talk about is just, like I said, there's so many different features when you have a term policy, especially, or any policy, but we're talking about term here outside of your job. And so one of the options that we always recommend is what's called a convertible term policy. So this feature allows you to convert your term policy to a permanent policy at a later date without going through the health qualification process. And so there could be cases, like we mentioned before, ideally you would be saving, for that 20 or 30-year term. And by the time that term is up, you would have enough money to cover, any of those bad things that could happen and kind of replace the need for insurance. In some cases, that might not be the case, and you could continue having a need for insurance. So having this convertible feature just gives you that option to convert it to permanent insurance if you really need it to.
I think you bring up a really good point about converting term to permanent insurance. And I know it might have sounded like we're a little bit of haters as it pertains to whole life, because like I said, there's so few people in the realm of whom we work with where it is actually relevant. But Chloe, I know you used to work with a high net worth individuals. Was it ultra high net worth that were your? Yeah. So how do you qualify as ultra high net worth? Like, how much money do you have to get there?
Yeah. So typically, once you get in the ultra high net worth category, you have a net worth of about 10 million and above.
Okay. Oh, so people over $10 million. Yes. Not quite there yet. Clients not quite there yet. But what I was going to ask is, do you feel that it's sometimes more appropriate? I've seen it used as a tool for people who have extreme wealth like that. And that's where it kind of comes into play more frequently.
Yeah, definitely. One of the things that that permanent policies are good for is, estate planning. There's the thing called the estate tax. And so if you are wealthy enough, which in a lot of cases you have to be very wealthy, but you do pay, some estate tax. And so that the life insurance policy could be used to kind of cover that tax bill so that your heirs can get, the full amount of your estate without, giving some of it to Uncle Sam. And there's a couple of other good reasons too, but yeah. And a lot of like high net worth families, they do use permanent policies.
Perfect. So high net worth may be plausible for you. Normal, average Joe, look like myself, not appropriate for me. All right, let's get to some closing comments. I think we've done a really good job of giving an overview of insurance. Like I said, our goal was not to inundate you with things to make you feel overwhelmed or feel like you don't know where to start. It was to try to kind of simplify these things so that you can get going. And so, one of the things we want to recommend is that you find reputable places to go for life insurance, which is definitely easier said than done because you have to be aware that on the insurance side of things, the agent is going to sell you a product, and that is how they make their living. And everybody has to make a living. So it doesn't mean that every agent out there selling insurance is a bad person, but there is a conflict of interest that is innate. And so they may try to sell you the sun, the moon, the stars, and far more insurance than you need, tell you that it's going to be great for you. And it's not necessarily exactly what you need. So you want someone who, has good morals, values, and integrity, in addition to knowing the various products well, and is going to choose what is right for you. If they go straight to whole and they don't ever talk about term, and we've talked about it as much as we have tonight, that might be your first red flag. Chloe, do you want to maybe share some of the questions and things that people should be thinking about as they go and get insurance?
Yeah. So one thing I'll add to that is that, like Lauryn said, the insurance agents, they make money by selling you an insurance product. So if you walk away and you don't buy anything from them, they don't make money. So naturally, the solution for every problem that you have is going to be insurance. And also with permanent insurance, just because of the way the products are structured, they pay a higher commission. So, that's another reason why an agent might push you to buy a permanent policy. And we're not beating up on permanent policies. There is a place for them, but just, kind of understanding what's appropriate for you at the appropriate time in your life, is super important. So some questions to ask, of course, is just kind of understanding, how does your agent get paid? A lot of people get suckered into buying insurance because, the commissions is hidden. We, like Lauryn and I, we both charge flat fees for our advice that we give. And so clients can see, the fee that they're paying. But when you buy a product, the commission or the amount that the person gets paid is built into the product. So just understanding, how they get paid, what they're getting paid for selling you this product, kind of helps you to understand, their motivation. Also, what might cause the policy to lapse. So in a lot of cases, if you skip a premium payment or if you forget to pay, there is a grace period, but you want to make sure that you don't miss that grace period, that you understand, when the premiums are due, possibly set it up on auto pay. Can you pay monthly, or do you want to pay once a year or quarterly? Just what's most appropriate for you. And we talked about before with permanent policies, you can take out loans and you can, get to the point where your policy does lapse if the cash value goes away. So just make sure that you understand kind of, what you need to do to keep that policy in place.
Yeah, and as I'm thinking about this and policies lapsing, I'm being triggered because I actually had not my life insurance, but my homeowner's insurance lapse about a year and a half ago, maybe 2 years at this point. And it was simply because I just didn't get any notification. So it was not on auto pay. They didn't have, I guess, updated information. They didn't send any mail things, but a really good thing to be doing as we think about closing comments is to reevaluate your insurance on an annual basis, to reevaluate your beneficiaries on an annual basis, and make sure that everything is in good standing order. So if you're on auto pay, it's great to set it and forget it and know that it's getting paid, but you also don't want, a card change to happen and you don't realize that it's not on auto pay and you pass away and you have no insurance. God forbid you change the addresses and the mail didn't get to you. So to be vigilant about looking at that. And then also, like you said, as life changes, if you get a divorce, if you have children, those various things, who are the beneficiaries? Who are the people you want to inherit this money should something happen to you?
Yeah, and that's so important, Lauryn, to talk about just, reevaluating the needs. You might get the policy, like we said, if you're single and you anticipate getting married and having kids in the future, you might get a policy when you're single, but once you get married and once you have kids, your needs might change and you might need more coverage, or you might get a policy when you have one kid and now you have three kids. And so you might need to up your insurance coverage a little bit. So just, yeah, make sure that you definitely reevaluate that and look at your beneficiaries and see if you make a change to your will. We talked about estate planning a couple episodes back. But yeah, if you have any changes to your will, and just, making sure that you're coordinating that and understanding, okay, if I'm setting up my estate to go here, should my beneficiaries change? And so that's something that you could talk about with your estate planning attorney and also, financial advisor.
And that is all we have for you all today, except for our money quote. So today's money quote is always plan ahead. It was not raining when Noah built the ark. And I feel like this is perfect. It's by Richard Cushing. So if you don't know the story of Noah and the ark, it rained, and it rained hard, and everybody drowned because they were not, in fact, prepared. So you want to plan ahead for the things that you cannot see coming around the corner. And it's going to be a really, really important thing. Life insurance is going to be a part of that.
Yeah, definitely. And of course, God told Noah to build the ark in advance, but we're telling you now in advance to buy the life insurance that you need before it's too late. So I wanted to say we're wrapping up our series, and this is our last episode together. But we do have a bonus episode that we're doing next. And so it's going to be with a group of some of our friends that are also financial planners. They're all women of color in the industry. And so we're going to talk about just how to help women of color get ahead financially, because we all work with, so many women of color. And we thought this is a good topic to kind of round out our series. But I do appreciate you, Lauren, for inviting me to do this series. And you haven't heard The Last of Us. We're going to continue to put out content in different ways, but this is the end of our podcast series for now.
The end for now. This is so long, but not goodbye. Chloe, you have been amazing. It has been so fun working with you on this project. I don't know how I would have got it done without you. You take excellent notes. Much more organized in that regard. I'm more shoot from the hip kind of girl, but we are an awesome team together, and I look forward to working with you in the future.
All right. So we are signing off for this episode. And like I said, stay tuned for the bonus episode that comes next, and we will see you then.
It's gonna be fire.